Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today, Circle Internet, issuer of USDC, the world's second largest stablecoin, and the infrastructure layer for the internet economy.
Circle was founded in 2013 in Boston by Jeremy Allaire and Sean Neville. The original pitch: make sending money over the internet as easy as sending an email.
In 2018, Circle co-founded USDC with Coinbase through a joint venture called Center. USDC is pegged to the US dollar, backed 1-to-1 by cash and short-duration US treasuries.
In 2022, Circle bought out Coinbase's stake and became the sole USDC issuer, gaining full control over the reserve strategy, compliance framework, and product roadmap for the stablecoin.
Circle went public on the New York Stock Exchange in April 2025. Most recently, revenue was $694 million, up 20% year over year, though slightly below the 715 estimate.
Revenue is driven by interest on the reserves backing every USDC in circulation. When rates are high, revenue is strong. As rates fall, that tailwind shrinks, a structural sensitivity the market tracks closely.
Despite the revenue miss, the volume numbers stand out. On-chain transaction volume grew 263% year over year. USDC in circulation grew 28%, exceeding 60 billion outstanding.
Net income was $55 million, down 15% year over year. The decline reflects a post-IPO spike in stock-based compensation, $51 million in Q1 versus $13 million the prior year.
Circle announced a $222 million ARC token presale at a $3 billion valuation. ARC is designed as a utility token for Circle's on-chain financial services and AI agent ecosystem.
The moat is regulatory trust. USDC is the most rigorously attested stablecoin, monthly independent audits, full reserve transparency, U.S. money transmission compliance. Tether operates with far less public disclosure.
That positioning makes USDC the preferred choice for institutional users and corporate treasuries. Circle was also first to receive regulatory approval under the EU's MiCA framework.
The AI agent angle is real. Autonomous agents need a programmable currency to transact without human approval. USDC runs on 20-plus blockchain networks with APIs built for programmatic use.
Tether holds the largest stablecoin market share but faces transparency questions. Coinbase earns USDC revenue sharing without controlling issuance. PayPal launched its own stablecoin at a fraction of USDC's scale.
USDC's network effect compounds with each new integration. Available in 180 countries across 20-plus chains, every added application raises the cost of switching to a competing stablecoin.
Jeremy Allaire has been CEO since founding Circle in 2013. His prior company, Allaire Corporation, built Cold Fusion, an early web application platform. He has been building internet infrastructure for 3 decades.
Allaire has been unusually vocal on digital currency policy, testifying before Congress and advocating for a U.S. stablecoin framework. That public role shaped Circle's positioning as the institutional-grade compliant issuer.
USDC runs on 20-plus chains including Ethereum, Solana, and Base, accessible from 180 countries. That breadth is a structural advantage over narrower stablecoin competitors.
Circle Internet just posted a revenue miss, but on-chain volume surged 263%.
Let's get into what USDC's growth actually means for the business.
Stablecoin infrastructure, on-chain volume surging, AI agents running on programmable dollars. Circle is positioning USDC as the currency layer for the next internet. Now let's get into the numbers.
Circle Internet Group reported Q1 2026 EPS of 21 cents, beating the 18-cent estimate, but revenue of $694 million missed the $715 million consensus, as interest rate dynamics compressed USDC reserve income. USDC in circulation reached $77 billion, up 28% year over year. The Genius Act stablecoin legislation is advancing through Congress, and Circle is positioned to be its biggest beneficiary.
Circle Internet Group is the issuer of USDC, the world's second largest stablecoin and one of the most consequential financial infrastructure companies in the crypto ecosystem. Founded in 2013 by Jeremy Allaire and Sean Neville in Boston, Circle enables individuals and institutions to hold, send, and receive dollars in digital form on over 15 blockchain networks. USDC is currently circulating in over 190 countries.
Circle went public in 2025 at a valuation that reflected substantial uncertainty around stablecoin regulation. Since then, the passage of early versions of the Genius Act through Senate committee and the CC's clarification of stablecoin accounting rules have removed two major overhangs. At $20 billion in market cap and $2.6 billion in annual revenue, Circle is valued at roughly 7 times trailing revenue, a fraction of what its regulatory clarity should eventually command.
Q1 2026 revenue of $694 million missed the $715 million estimate by 3%, the first revenue miss since Circle's IPO. The shortfall reflects the Federal Reserve holding rates steady in Q1, which maintained USDC reserve income at prior quarter levels while the Street had modeled a slight sequential increase in USDC supply. EPS of 21 cents, beating the 18-cent estimate, shows operating expense discipline compensating for the top-line miss.
Circle's revenue model is straightforward but sensitive to interest rates. Approximately 85% of revenue is interest income earned on U.S. Treasuries and money market funds backing USDC reserves. When USDC supply is $77 billion and the Fed funds rate is 5.25%, the math is approximately $4 billion per year in interest income before Coinbase's 50% revenue share and other distributions.
USDC circulation growth is the most important metric. $77 billion in Q1 2026 represents 28% growth year over year from $60 billion in Q1 2025. International institutional adoption is accelerating. Payment rails in Southeast Asia, Latin America, and Sub-Saharan Africa are switching to USDC for cross-border settlement because it settles in seconds rather than the 2 to 3 days required for SWIFT wire transfers.
The Coinbase revenue sharing arrangement is Circle's primary cost of revenue. Coinbase earns approximately 50% of interest income on USDC held on Coinbase's platform and distributed through Coinbase's wallet infrastructure. As USDC expands to non-Coinbase platforms and wallets, Circle retains a higher percentage of reserve income, improving its net revenue per dollar of USDC in circulation over time.
Operating margin reached 12.1% in Q1, up from 8% a year ago. Circle has been disciplined on headcount, holding engineering and compliance growth to 12% despite a 30% revenue increase. Free cash flow generation of approximately $220 million on a trailing 12-month basis demonstrates that the business model is structurally profitable at current USDC supply levels.
Jeremy Allaire co-founded Circle in 2013 and has served as CEO throughout its growth from a consumer Bitcoin app to a global stablecoin infrastructure company. Allaire is one of the most credible voices in digital asset policy. He testified before Congress multiple times during the Genius Act drafting process, and his regulatory engagement is a core reason Circle has maintained compliance-first positioning that competitors have struggled to replicate.
Analyst consensus heading into Q1 was approximately 12 buy ratings, 5 holds, and 1 sell. The average price target was $34, representing 28% upside from the pre-earnings price of $26.50. The revenue miss introduced short-term uncertainty, but the EPS beat and USDC growth trajectory kept most analysts from downgrading. Goldman Sachs and JP Morgan maintained their buy ratings immediately post-earnings.
Goldman Sachs's bull thesis rests on stablecoin legislative tailwinds. The Genius Act, if passed, would create a federal regulatory framework requiring stablecoin issuers to hold 100% reserves in U.S. Treasuries or cash and submit to federal supervision. Circle already meets these requirements. Competitors who currently lack full reserve backing would face compliance costs that Circle doesn't, a regulatory moat built on voluntary early adoption.
JP Morgan's analysis focuses on the cross-border payment opportunity. Global cross-border payments are a $23 trillion annual market dominated by SWIFT, correspondent banking, and traditional wire networks that are slow and expensive. USDC as a settlement layer could capture even 1% of this market, $230 billion in annual settlement volume, generating approximately $2 billion in additional annual revenue at current reserve income rates.
The bear case from skeptical analysts centers on rate sensitivity. Every 25 basis point Federal Reserve rate cut reduces Circle's annual interest income by approximately $190 million at current USDC supply levels. In a rate-cutting cycle, Circle's revenue growth could stall or decline, even as USDC supply continues to grow. The bears argue that the market is not fully pricing in this earning sensitivity.
The consensus view: Circle is a bet on stablecoin adoption becoming institutional infrastructure, not a crypto trading play. If USDC becomes the settlement layer for cross-border payments, corporate treasury management, and tokenized assets, the total addressable market is measured in trillions rather than billions. Watch USDC supply growth and Genius Act progress as the two primary catalysts.
The bull case is USDC becoming the digital dollar for global commerce. Every large bank, payment network, and e-commerce platform is evaluating stablecoin integration. When a Fortune 500 company holds $50 million in USDC for operational treasury management instead of bank deposits, that $50 million earns Circle reservation income that traditional banks would have captured. This use case is early but accelerating rapidly in corporate treasury.
Legislative clarity is the unlock. The Genius Act would formalize USDC as a legitimate financial instrument under U.S. law, opening it to pension funds, sovereign wealth funds, and institutional investors currently prohibited from holding crypto-native instruments. The addressable market expands from crypto-native users to the entire institutional financial system. The value unlock from that expansion dwarfs current revenue by an order of magnitude.
The network effect compounds. USDC integration into payment rails, DeFi protocols, and corporate treasuries creates switching costs for users. Once a company's accounting system, payroll provider, and banking partners all accept USDC, transitioning to a different stablecoin requires rebuilding every integration.
The bear case starts with Tether's dominance. USDT has approximately $125 billion in circulation, more than 5 times USDC's $77 billion. Despite operating with less regulatory transparency than Circle, Tether maintains its lead because crypto traders prefer USDT on offshore exchanges where Circle's compliance requirements create friction. If Tether gains U.S. regulatory approval in a form that preserves its offshore model, Circle's differentiation narrows significantly.
The Fed rate cut cycle is the most immediate risk. Circle's revenue is a function of USDC supply times the federal funds rate. In 2024, when the Fed began cutting rates, Circle's quarterly revenue growth stalled despite USDC supply growing. If the Fed implements 4 to 5 rate cuts by end of 2026, which some economists project, Circle's annual revenue could decline even with 20% USDC supply growth.
Coinbase dependency creates revenue floor risk. The 50% revenue share with Coinbase on USDC held on Coinbase's platform is embedded in a long-term contract that Circle cannot easily renegotiate. If Coinbase's share of USDC distribution increases, which is possible as Coinbase expands internationally, Circle's effective margin on its core revenue stream compresses. Any renegotiation by Coinbase would create a headline risk event.
Regulatory risk is bidirectional. While the Genius Act benefits Circle, hostile crypto regulation, particularly anything targeting stablecoin issuers' ability to earn.
Circle's closest public comp is Coinbase, its primary distribution partner and partial competitor. Coinbase trades at 8 times trailing revenue on cryptocurrency exchange volume, a business with significantly higher volatility. Circle's more stable reserve interest income model, once understood by investors, should command a meaningfully higher multiple than volatile trading fee businesses. The current valuation gap between Circle and Coinbase favors Circle on a risk-adjusted basis.
PayPal is the traditional fintech comparison. PayPal's stablecoin launch, PayPal Boy USD, is a direct competitor to USDC in the U.S. consumer payment space. However, PayPal's institutional distribution, corporate treasury adoption, and DeFi integration lag Circle's by years. PayPal trades at 17 times earnings, a premium to Circle's current multiple, despite a less differentiated stablecoin position.
Block is the peer for crypto-native fintech. Block's Cash App integrates Bitcoin and now stablecoin functionality, targeting the same retail consumer base as Circle's earlier consumer-focused products. Block trades at 25 times earnings on growth expectations, higher than Circle, but without the institutional and cross-border payment tailwinds that make Circle's long-term revenue model more defensible at scale.
Pre-earnings options positioning was cautiously bullish, with implied volatility suggesting an 8 to 10% earnings move. The actual reaction was mixed. A modest post-earnings dip on the revenue miss, followed by a recovery as USDC growth data was absorbed. Circle is still a recently IPO'd company where earnings expectations are being calibrated in real time, creating wider than normal post-earnings price discovery.
Post-earnings options activity showed increased interest in longer-dated calls, particularly $30 and $35 strikes for September and December expiration. This positioning reflects investors betting on Genius Act passage as a catalyst. The legislation's timeline is a key uncertainty. Senate passage before the summer recess would likely be a 10 to 15% near-term catalyst for Circle's stock price.
CEO Jeremy Allaire has not sold shares since Circle's IPO, a meaningful signal for a recently public company where founders often sell into early lockup expiration. Circle's institutional investors from the venture rounds, including General Catalyst and IDG Capital, have similarly maintained positions rather than distributing shares to their LPs at the IPO price. This insider discipline suggests internal confidence in the multi-year trajectory.
Institutional positioning is bifurcated. Traditional fintech funds that understand payment rails have been initiating or adding to positions. Crypto specialist funds are reducing exposure as Circle's revenue is largely tied to interest rates rather than crypto price appreciation.
Circle delivered EPS beat despite a revenue miss, USDC supply at 77 billion growing 28%, and operating margin expansion to 12%. The revenue miss was rate-driven, not adoption-driven. USDC is growing. If the Genius Act passes, Circle gets a regulatory moat and institutional market expansion that transforms its total addressable market.
Risks are real: rate sensitivity, tether competition, Coinbase revenue share, and regulatory uncertainty. Circle is a high-conviction bet on stablecoin infrastructure becoming financial plumbing, not a near-term momentum. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.